Hello everyone, and thank you for joining our discussion today on DAC6. For those of you who do not know me, my name is Sudha, and I'm the Head of Corporate Tax at Wheelhouse Advisors, a firm that provides tax, accounting, prudential management, regulatory reporting, and HR services. I'm super excited to be hosting today's webinar with friend of the firm, Ali Kazimi from Hansuke Consulting. Some of our clients who are listening to this webinar may already know Ali, as we recommend him for FATCA, CRS, CCO, and also DAC6 work. For those of you who do not know Ali is the Managing Director at Hansuke Consulting and has been in the FS tax industry for over 25 years. Please do introduce yourself in the chat section and feel free to raise questions on the Q&A button. If we have time, we'll try to answer them. If you miss anything, you will have access to the on-demand recording straight after the webinar ends. So why are we doing this webinar? When DAC6 was first spoken about, my initial reaction was that this was for aggressive tax planning, and it's not relevant to the clients that I deal with. Straightforward fund managers with an LLP, individual members, a corporate member, perhaps a Cayman parent company, managing the typical Cayman master feeder fund structure. Nothing fancy for tax planning. However, when I started reading the detail and new guidance was issued earlier this month, it became quite clear that whilst it targets tax avoidance, normal commercial transactions could still be within the regime. So DAC6 is something which should not be ignored. And even if your initial thoughts are that it is not relevant to you, there is still a process which you should go through in terms of documenting your review and ensuring that you have a system in place to ensure that any future transactions that could be within the regime are picked up. Ali will talk about this during the course of the discussion. So let's kick off and go back to the beginning. Ali, what is DAC6?
First of all, thank you very much, Susa. It is indeed a pleasure to be working with you again. As you mentioned, we work very closely with you. And, I'm particularly pleased. I mean, this is the second DAC6 webinar I'm doing today, but I'm particularly pleased to be talking on this one, as the investment management sector is a industry that's very close to my heart. I started my career with essentially BlackRock. I headed up the tax team there. And so, we're going to be talking a lot about those type of issues. Now, DAC6 is an interesting regime. I have been quoted somewhere saying that it is by far the most technically complex automatic exchange regime to date. And I stick by that. I mean, we've been in this industry for some time. We've seen the likes of FATCA, offshore reporting funds, all of these type of regimes are there. But DAC6 is quite unique. It goes beyond anything that I have seen, in my 30 years in the industry. DAC6, you ask, what is it? It's a new EU directive, and it's basically designed to strengthen the tax transparency over harmful cross-border tax arrangements. That's simply what it is. The rules are intended to give tax authorities that visibility over aggressive tax planning. However, the scope of DAC6 is intentionally wide, so it could include arrangements that may not have any visible apparent tax objective to them and yet may be reportable. So in that way, it's not dissimilar to, say, DAC2, which is the Common Reporting Standard, the CRS. So it has that mechanical element to it. So you must lodge these files whenever you see certain fact patterns emerging. So what I would one of the things that I should emphasize here, and it's a philosophical point that people need to get over, is that there is nothing wrong, morally wrong, in filing a DAC6 report. A lot of people are just scrambling not to report. And I think that may be the right thing, but let's take the sting out of it. We're not talking about tax evasion here, which is a criminal illegal act. We're talking about tax avoidance. And to the extent that you find yourself within the sort of like, you fit the rubric, then there is something to report. So that's basically the quick background. It is a EU measure, and that links, or that brings up the question about Brexit. And the key thing I always tell people is Brexit does not change things. The directive has been transposed into UK law, and it is the intention of the UK government to basically continue with the directive once we exit or the transition period is over. Okay, and just for brevity purposes, I will refer to the UK and member state interchangeably. That is not a political statement on my part. It is just convenience. So the directive actually has been in force since 2018. However, it formally went live 4 weeks ago on the 1st of July 2020. And you probably have heard there's a lot of chatter around about deferrals and the like. And deferral was essentially negotiated. A further directive was passed that allowed, on an optional basis, certain member states to basically, on grounds of the C19 COVID-19 disruption, to delay the actual lodgement of the reports under DAC6. So some jurisdictions have taken that up, some haven't. Notably, Germany hasn't taken that up. Now, that has caused a certain degree of inconsistency and complexity within the marketplace. But I think the key date for our listeners today is the 25th of June 2018. That's when the regime went live, and the reporting essentially starts from across Europe from 31st of August. It can be deferred, as I said to you, if a member state has basically looked for that deferment. But in Germany, it is the 31st of August. So that's in quick outline what the key dates are about. Now, turning to the legislation itself, the directive applies to cross-border arrangements. So in this context, a cross-border arrangement means any arrangement which involves either two different EU member states or one EU member state and a third country. So there must be that element to that.
And so I guess, Ali, whilst this webinar is focusing on fund managers, it's actually relevant to an individual that may be having cross-border transactions. Is that correct?
Indeed, absolutely. And we will talk about where the reporting obligation falls. And you're quite right. You could get a situation whereby an individual taxpayer could be reporting on themselves. I will come to that scenario in a minute.
So that's interesting. So DAC6 is in relation to reporting certain types of cross-border arrangements. So what impact does that have on the fund industry?
Before I go to that, can I just talk a little bit about what is because I think one of the key concepts there's something displaying up there. If we can talk about what is a cross-border arrangement first, and then we'll specifically look at the funds industry. I think the key thing is, first of all, we need to understand that you must have a cross-border arrangement, which we said, must cover two things. The second part of that is it a reportable cross-border arrangement or not? And for a cross-border arrangement to be reportable, it must contain at least one of the hallmarks. A hallmark is simply a set of indicators, conditions, or fact pattern, which, if found to be present, is suggestive of potentially an aggressive, harmful tax practice. So if you've got a cross-border arrangement and it displays one of these hallmarks, then the next question is whether you're playing an intermediary role or not. And to the extent that you have intermediary role, then you go to the reporting side of things. So shall I turn to how it applies to the funds industry?
Yes, please. I mean, if you think about the type of clients I deal with, so it's a typical fund manager setup: UK LLP, UK individual members, corporate member, maybe a Cayman parent company. So, and a lot of the response I've had from clients is they just don't think it's relevant to them. So please do tell us what impact it has on the fund industry.
Yeah, I mean, I think the key thing for me, before we dive into the specifics of the fund industry, is that it wasn't actually written with the fund industry in mind as such. And that's why it makes it difficult to actually apply to the funds management industry. So if you look at it typically in, across the board, whether you talk about hedge funds, private equity funds, whatever, there will be three tiers. There's the investor level, there's the fund itself, and then there's the investment level. And, at the investor level, where a fund is being marketed or promoted to the investor, that clearly the promotion activity falls within, it's a very cross-border, it's a very international industry. So where you've got cross-border investments taking place, then certainly that would fall to be a cross-border arrangement and would create a prima facie sort of like argument for that cross-border arrangement to be looked at further, closer to determine whether hallmark has been triggered or not. So that's at the investor level. Then at the fund level, what you get is, right at the launch of the fund, it's the launch. The fund could be established in a low tax jurisdiction. So that in itself is potentially a cross-border arrangement, which may trigger one of the hallmarks. You would have, any seeding that is put in to the fund to kickstart its progress. That seeding itself could be sort of like an arrangement, and also sort of like quite often the complex remuneration arrangements that are put in place, whether for the sort of like the promoters, the principals, or within the fund structure itself. So these all could fall to be cross-border arrangements.
So you're not just focusing on the transaction between the fund manager and the fund. You basically have to look at who the main players in the structure are. So your investor, your fund, and the fund manager.
Absolutely. I'll just come to the definition of intermediary in a second. What I'll do is, just before I do that, I'm going to take it down to the next level as well, which is the investment level within a fund. That needs to be looked at as well. In a private equity setting, that would usually involve sort of like, setting up structures to access portfolio companies. A lot of say, for example, Luxembourg is a common jurisdiction for putting the holdco in, and then the structuring that takes place beneath that. In a hedge fund setting, that could be in, the prime broker would be sort of like involved in some of the investment transactions, and they could be doing some really sort of like fun stuff around the rehypothecation trades and the like. There could be use of synthetics, which, as you know, under FIN 48 or IRFIC 23 as it's coming in, has come in, would bring all of that sort of like, those issues into play again as far as DAC6 is concerned. Now, specifically, you mentioned, what happens, where does the responsibility for this falls? Well, the directive talks about intermediaries, and, the term intermediary is defined very broadly. And it basically, there are two types of intermediaries. There's the promoter. That's someone who basically designs, markets, organizes, or makes available for implementation, or manages the implementation of a reportable cross-border arrangement. The second category of intermediary is the service provider. The service provider is essentially someone who facilitates or enables the arrangement to be put in place. Now, in a fund setting, it could be the manager, it could be the fund itself, the general partner, or the administrator, transfer agent, prime broker, the banks, corporate service provider, any agent, trustees. All of these guys could be potentially intermediaries, and that's one of the challenges that the fund management industry poses.
I guess we could potentially be, myself as a tax advisor could potentially be a intermediary Is that correct?
I'm afraid and sorry to say that is absolutely correct. You do have potentially a intermediary responsibility. However, I mean, sort of like you need to look at your activity level. So when you are, as you say, filing a tax return or something, it's unlikely that you would be in a promoter category. You would be in a service provider category. And the service provider category does have a service provider is not an intermediary under DAC6 and therefore has no reporting obligations under DAC6 if you did not know or could not reasonably be expected to know that you were acting in relation to a reportable cross-border arrangement. So if you're aloof from that, then you're excluded.
And I think that's important for us, because if you think about the work that we do, we basically do the tax returns for clients, the reporting fund work. There may be some ad hoc tax advice from time to time, but primarily the preparation of a tax return and preparation of accounts, you're not actually aiding the design of an arrangement. So I wouldn't put myself into that category for doing that type of activity. But obviously, all tax advisors need to be mindful of whether or not they are falling into that category of assisting an arrangement.
I think that's really a good point. I think you need to be aware of what the role you play.
Just one other point, Ali. So you've got lawyers. Now, lawyers will be covered by privilege. So what happens in that instance?
Yeah, now that's an interesting one. So the directive recognizes that, and it provides for a exemption where a legal privilege is there, and that type of intermediary who enjoys legal privilege can basically is not his duty or her duty is waived basically to report. However, that there are two things I would add to that is the term legal privilege has been given different meanings in different EU member states. So in the UK, it's generally confined to the legal community, whereas in, say, Luxembourg, that has been given a far wider interpretation, and it also extends to auditors and accountants and sort of like tax advisors and the like. Okay. The other thing that we should basically also have regard to in relation to the legal privilege is that in certain instances there's commercial pressures that are driving this, whereby lawyers have been asked to waive their legal privilege and facilitate the reporting. Because they're the ones who designed it and they're best able to sort of like have the totality view of what the arrangement is about.
And just to be clear, so you can have multiple intermediaries. You can have the fund manager, the fund, a lawyer, an accountant. They could all be intermediaries, but surely not every single intermediary has to report on a single transaction.
Well, that's an interesting point. I think the starting off point is every intermediary has an independent responsibility to report. So first of all, you just look at and say, yes, I'm an intermediary and I have an obligation to report. Once you've got to that point, then you do the second part, which is to look around and see, was there another intermediary in play for that particular arrangement? And, sort of like, say, the UK tax authority, HMRC, has been very good about that. And they basically said, yeah, if you have got multiple intermediaries, then you don't all have to report. You have, and Luxembourg's been good with this as well, and you have this idea of a primary intermediary emerging who basically says, look, I'll take responsibility. I'll be the lead intermediary. And they then obtain what is termed a ARN, arrangement reference number, and the other intermediaries don't have to go through the full report. All they do is they basically cite the ARN. So that has to travel through the market, and what legislation or the guidance, regulations, guidelines are very silent on is what are the protocols, the communication protocols around the cases around multiple intermediaries, which particularly in the fund industry is very, very important to get right from the beginning. And that's where a lot of my work at the moment is around establishing those protocols.
Mm-hmm. Okay. So just to recap, so DAC6 is a reporting regime for certain types of cross-border arrangements. In order to assess whether you're within that regime, we need to look at certain hallmarks. So, Ali, I know you have a slide on hallmarks. It was in the middle. If you go back to the next one, there we go. It's the second sort of block diagram there. Oh, there we go. So can you talk us through these hallmarks and why these could be pertinent to hedge fund managers?
So, I mean, first of all, we have to understand what a hallmark is. And what I would sort of like do is just give you a bit of a background. The DAC6 comes out of the OECD's MDR work. This is the mandatory disclosure, reporting work. And that was essentially modeled on UK's DOTAS scheme. So these terms such as promoter and hallmarks are straight out of the UK sort of like playbook. And what essentially a hallmark is, it simply is a fact pattern which, if found to be in operation, is basically turns the cross-border arrangement into a reportable cross-border arrangement. Okay. And these hallmarks have been selected because they are felt to essentially be, sort of like to erode the tax base of a particular tax authority, tax jurisdiction. So if we look at these hallmarks, there's 5 of them. They're referred to as A, B, C, D, and E. And some of these hallmarks are specific and some of them are generic. The first 2 hallmarks, A and B, also have a further requirement, which is called the main benefit test. C partially has the protection of the main benefit test. So these are the hallmarks, they're fact patterns. And as the name suggests, they can be very generic or they can be very specific. And one has to work through each one to get to and determine whether the hallmark applies to the cross-border arrangement. So as we mentioned in the fund setting, it could be the capital raising from investors. It could be the establishment of the fund. It could be the actual investment structuring that's taking place. At each level, one needs to see whether hallmark has been applied or not.
Ali, you mentioned main benefit test. Do you mind just explaining what that means?
Sure. So one of the things that basically we have this requirement, that a threshold requirement, if a hallmark has been met. So if you look at, say, for example, hallmark A, we're talking about the standardized documentation. So standardized documentation is suggestive that this is a tax arrangement that should be reportable. However, there's a further requirement, which is the main benefit test. And basically, the main benefit test comes from OECD sort of like commentaries. Obviously, in the UK, we have a lot of historic legislation and case law to help guide that. So if I look at, say, for example, the German guidance, they provide that a tax advantage must be the principal purpose of an arrangement in order for the main benefit test to be met. And therefore, if there are valid non-tax reasons, essentially commercial or economic reasons for the transaction to have been undertaken, then that main benefit test has not been met. So the UK, sort of like also HMRC again has gone much further and basically they've said that we expect the main benefit test will not be met unless there is a presence of abuse. Okay, so that it wouldn't go against the law or the intention of the legislator. So it's quite a high threshold mark to meet, and which is really useful for industry, because we will be using this as a shield not to report. But again, what you said right at the beginning, it has to be clearly documented. There must be commercial rationale that needs to be put in place in order to demonstrate that main benefit test has not been triggered.
That's interesting, Ali, because I'm quite cautious. For those of you guys who know me, I'm quite cautious, and I recall a meeting we had with HMRC, and it wasn't to do with DAC6, but it involved a piece of legislation that required there to be a tax advantage, and the inspector and the manager of the inspector both said that as long as there is some sort of tax advantage, whether that's tax deferral or a tax deduction, we will treat that as being a tax advantage arrangement. But I think what you're saying is you got to take a judgment as to whether or not the presence of a tax advantage, which is incidental to the arrangement, is something that should be reportable or not.
Yeah, I mean, this is a good philosophical tax point that which needs to be obviously implemented in a practical setting. But I think the key thing is so that first of all, it's not very well laid out. Let's make no bones about it. There is confusion in the marketplace. It does require exercise of a professional tax practitioner to be able to make that call, whether the MBT has been satisfied or not. You're putting the dividing line much closer based on your interaction with the HMRC. I work on the basis that to the extent that a transaction has very strong verifiable commercial rationale underpinning it, then we can go beyond the we don't believe that the MBT has been triggered. Mm-hmm. If, however, the transaction fails to stand alone on its commercial grounds and it is only viable due to the tax spin on it, to me that is squarely within that. And I use this analogy quite often. Some of you who deal with me will know this. Is you do not get married to take advantage of the married couple's allowance. Okay, so it's a lot to do with your intention. Mm-hmm, mm-hmm. Okay. But you're right; it's very subjective, and it needs to be documented and clearly set out.
Mm-hmm. Okay. Do you want to focus on some of the hallmarks that we'll typically see with hedge fund managers, such as hallmark B?
Sure. I mean, sort of like, I think one of the issues is about that the conversion of income into capital. That's particularly in the private equity hedge fund industry, the carry structure is a key part of structuring a fund. Okay, just for the benefit of those who are less familiar with that, a carried interest is the share of the profits that a general partner of an investment fund receives from their ownership interest in the fund's assets. Okay, and that's a very important part of the industry, the carry structure, because when investors come into a private equity fund, they want to sort of like, the first question they ask the principals is, what's your, have you got skin in the game? So, and that's a way to demonstrate that. Now, the carried interest element, the remuneration element, is subject to capital gains tax because it's taxed as if it was an equity investment. Now, that has come under a lot of criticism. if you look at particularly across the pond, in the United States, whether it was, both the Obama and the Trump administrations do not like that treatment. To them, this is a form of income. Why is it being taxed as capital? So I think that's whole sort of like, issues going on. Even in the UK, I think it was last week, I wrote a blog just on sort of like what's happening with regards to the new review that the Chancellor has asked the Office of Tax Simplification to undertake on the treatment of capital gains. So I think that all of these areas are really important, how you flip between income and capital. So the DIMF, the disguised investment management fees, sort of like legislation, had the effect to actually codifying the carry, and they basically confirmed that the carried interest will be taxed as capital, because what it did was, and it's a bit of sort of like legal gymnastics. What DIMF did was basically they confirmed that the fund manager is treated as carrying on a trade, and any fee for the management of the fund is taxable as income. So therefore, by definition, that which is outside is therefore confirmed as basically as chargeable gain. Okay, and this was sort of like very much the BVCA had this gentleman's agreement with HMRC, but now it's got sort of like legislative force. Now, so we have this piece of legislation, the DIMF rules, and yet we've got now this DAC6 to contend with. What do we do? Do we report it, even though it's legislatively provided for, or not? Now, this is where, rather helpfully, UK HMRC has said, look, the main benefit test, there must be an element of abuse. So the fact that legislation provides for that recharacterization or that treatment, that is fine. However, you could have another intermediary. So you could have the UK manager with a Luxembourg intermediary. What is the Luxembourg intermediary to do? They don't have that kind of guidance that the UK has provided. So do they report or not? And these are the kind of detailed type of things that we need to work through.
That's interesting. I mean, just sticking on DIMF, I mean, this particular hallmark, whilst it talks about recharacterization of income into capital, the guidance does say it's not just capital, it's any other stream of income. And so you do have income that's taxed at different rates. Now, if we think about DIMF, within those rules, if DIMF applies, you could have a dividend that's taxed as a trading profit in the individual's tax return. So if a person applies DIMF in his tax return, obviously there's a recharacterization of income streams. It sounds like from what you're saying to me is that there's it's a judgment call as to whether or not something like that needs to be reported.
Yeah, I think what we have illustrated through this is whatever call you're going to make, it has to be written down very, very clearly, because my fear is that HMRC comes knocking on your door and says, "Hey, Suta, how comes you didn't report that?" So you need to be able to say, "Well, hang on a second, I'm just a service provider in this, and I have no sight on this." The other service provider, you sit next to say, for example, the firm of accountants or the lawyers who basically designed this whole arrangement. Now they can't claim that particular lack of knowledge. They do have the knowledge. They must then have a better argument than yours to be able to say, "Well, actually, we've looked at the transaction. This is our view." Okay. Now, in a fund setting, these are the external guys, but you get a odd situation whereby the fund manager is a different entity to the fund itself, and they must work out how it applies to them. And I think that's really sort of like the point that's coming out of this is, we won't be able to get to a final thing, but we've demonstrated that this is a complicated area.
Can you talk about hallmark B3? So you've got it on your slide as round tripping of funds. I always think of it as circular transactions. And I think that's something that could be relevant to hedge fund managers. Could you talk a bit more about this particular hallmark?
Yeah, round tripping sounds a lot more fun. It gives me an idea of a carousel that you're going round and round or something. But you're right, the circular transactions, which those of you with a keen eye on, say, for example, UK taxation developments will know is a hark back or a reference back to a homage to the Ramsey principle. And, what Ramsey principle is about is where you have a sequence or a series of steps and their self-cancellation, and they end up, you could go from A to B, or you could go A, B, C, D, E, F, G, and end up in the same place. So the whole idea was that these additional steps will be sort of like, they take you to the same place, you cancel them out and remove the tax advantage. And that's what essentially circular transactions doing. They're basically not changing anything, but they are essentially contriving you to benefit from a tax benefit advantage. And that type of structure is reportable, as you say, under hallmark B, and that needs to be brought into play, unless you can sort of like, rely on the shield, the MBT shield.
So again, if you think about the type of clients I deal with, your UK LLP, a corporate member, Cayman parent company, and the individual members are also shareholders of the Cayman parent company. Suppose you have a profit allocation to the corporate member, and then that is then dividend up to the Cayman parent, and then the dividend is paid to the UK shareholders, assuming the mixed membership rules are all fine. Essentially, you've got profits from the UK going through a chain and then ending up to the UK individuals who could put that back into the LLP, either to settle their own current accounts. And in that chain of steps, there is a tax advantage because you get the advantage of tax deferral. You can take the dividend out later. And obviously, dividends are taxed at a lower rate than income tax. Is that the type of thing that could be considered to be a circular transaction?
Absolutely. I mean, I think that's exactly the type of thing that is potentially within the ambit of this, or they had in mind. Now, I mean, there's two ways of looking at it. One is to mechanically apply and say, these are a set of rules, and that's very important when you're trying to operationalize matters. The other way to do it is to sort of like look at each transaction in that manner and treat it on its own merits. And you've got that whole tension going on. Now, I think sort of like you can take a purposive approach and you sort of like saying, well, what is it that we're trying to do? What was the main aim of this legislation? The main aim of this whole exercise is to essentially give visibility, like the UK DOTAS scheme did, to let tax authorities know what new wonderful things are happening that they may not be aware of. Okay? So it's an early warning signal. Now, to the extent that it's a pretty well-trodden path, then I would look at the MBT. If I find that even if the MBT doesn't provide me the protection, then, I don't think there is any, as I said to you right at the beginning, we have to have a cultural shift in this, is, if it is what it is, treat it on its own merits. And if we have got essentially a circular transaction or a recharacterization transaction, we have to report it.
Okay. I can see that we're already 40 minutes into the discussion. Let's move on to intergroup loans, Ali, so hallmark C. And this is something that I see within, especially with real estate clients, where you have a related company, say in Jersey, with another company that owns UK real estate, and the Jersey company provides mezzanine finance to the property holding company to acquire the property, and that mezzanine finance would be subject to interest and parking, things like anti-hybrid rules and all sorts of other tax avoidance rules. The property holding company gets a tax deduction for the interest paid up to the Jersey company, which is not, well, in Jersey, tax rate is 0%. So is this something that's, why don't we talk about hallmark C and then explain whether this type of scenario is something that could fall within hallmark C?
Yeah, I mean, the industry is a lot of discussion and debate is around, sort of like these debt push down sort of like structures.
Hmm.
Are they caught within it or not? Um, the view generally is that again there is now there's most emphatically there is an argument that they are a cross-border arrangement. I mean, there's no stepping away from that. Now the question is, have we triggered has it become a reportable arrangement or not? And the fact that we are pushing things into sort of like removing the tax base and transferring it to a low cost or no tax jurisdiction, that clearly is there. We look at the MBT, but again, I mean, I think those type of structures very much are within the frame, and firms, particularly with the property industry, need to be looking at this very, very closely. And that's not just property things. If you look at, say, for example, down to hallmark E, this idea of associated parties, where we have the base erosion through these arrangements, whereby you transfer, functions, risks, assets, and you reduce the EBIT below 50%, then you're in play. And again, I'm dealing with the various funds at the moment. I mean, they're having some real intellectual dissonance, whereby they're coming to terms with, but I thought I never was going to report. But who told you that? Okay, if the writing is on the wall and you have got this type of group arrangement, you've got PICs or whatever that you've got in place, then you have to start looking at them very, very closely. I mean, they were designed for a purpose, and no one in their right mind is going to sort of like saying, deny that some of these structures were there in order to optimize the tax position. Now the question is, to the extent there's an MBT in place, was that the main benefit, or is there some protection that can be had from the MBT threshold not having been met? Now, I'm always sort of like, when I look at these structures, and this is going to the heart of the MBT arrangement, is would a transaction, if you remove the tax advantage from that, the tax benefit, would it be able to stand on its own 2 feet?
Very good.
And if you're getting a return which is 100 plus, after tax, you remove the tax, is it still above 100? But if it's below the line, then clearly the MBT threshold becomes very difficult to rely upon. So, everybody, once, say, for example, you get into a situation whereby the MBT protection isn't available and it's smelling, pretty nasty, and it's going to be reportable, then the next question becomes, I mean, this is when sort of like it becomes a bit more divisive between the multiple intermediaries. Well, who is going to now report it? And then, service providers will run for cover and they say, well, I was just a service provider. I wasn't the intermediary who designed it, who promoted it. And that's really where the sort of like the shaking up is going to take place. And you get into a really nasty situation whereby, the lawyer who basically devised it steps away claiming legal privilege. And it's the poor taxpayer, or I shouldn't say poor, I'm sure they probably did rather well out of it. But, the taxpayer is then left holding the baby and they must report on themselves.
Ali, I'm just keeping an eye on the clock as well. And
sorry, this is an interesting topic. I enjoy this.
There is one other hallmark which I think is quite important, and that's hallmark D, where it talks about undermining CRS. Are you quickly talk about that?
Yeah, very important. And all this discussion about MBT and so on, the main benefit test, doesn't apply here. And in fact, this is arguably the most important part of all the hallmarks, because when you look at the development of DAC6, it grew out of the MDR regime that the OECD had put forward. Okay, and That didn't have all these extra bits and pieces. That was squarely about the undermining, the thwarting of the CRS side of things. And how they were being thwarted were essentially through, golden passports, or through sort of like intermediate structures, which were essentially allowing firms to get away, and CRS being frustrated. So what they've done is they've basically sort of like brought this in. It's very wide ranging, because sort of like the the United States is a non-cooperating jurisdiction.
Mm-hmm. I mean, that's interesting, because if you take me as an example, I'm a UK resident individual, and suppose the extreme case that I leave the UK and I move to a particular jurisdiction, or in the extreme case that I am not resident in any jurisdiction, that is something that would then undermine CRS. So a fund admin needs to have in place a system where it can detect which particular jurisdictions they are, what tax resident status they have. So that seems like a really difficult project for a fund admin to do itself. Okay.
Just on that, I think the key thing is, we'll talk about how people become compliant, but I think that's the key thing, that the mechanisms need to be there to be able to at least capture this activity taking place. And then you make a judgment call as to whether one of these hallmarks has been triggered or not. Now, my concern is actually the mechanisms just are not there to capture a lot of these things.
Okay, so we've talked about circular transactions, income into capital, intergroup loans, undermining CRS. We talked a little bit about transfer pricing. Is there anything else that you would like to say, or are you happy to move on to the next phase?
No, let's stop. I'm just conscious of time as well.
Yeah. Okay. So we've talked about the various hallmarks which are relevant to fund managers. So what should our clients be doing?
Well, I think the first thing is, and stepping back from all of this, is that look, there is a lot of confusion out there, okay, about what DAC6 is and how it applies and when it applies. To me, the first thing, there is a real gap in understanding. People don't realize that, look, hang on a second, DAC6 does apply to us. And I think hopefully, that's what we've tried to illustrate, that yes, it does apply at every level, okay? So the first thing I would say is educate yourself on what DAC6 is, and find, if you don't have the time because of COVID, find a guide who can help you navigate this complex regime, okay? So that's very important, the education side of things. The other key thing, particularly for the funds industry, I was talking to the banks this morning, less so for them, but for the funds industry, it is vitally important that you are communicating to your board, to your stakeholders, get their mandate, get them engaged, okay, on what your approach is going to be. The moment you have their buy-in, then you need to start looking at what are the facts? How do the rules apply to your specific, structure? Okay. And, I've heard so many times people say, oh, well, I'm just a simple, sort of like, master feeder, structure book standard. No, we don't have to worry about it. Well, the moment you sort of like say, oh, that's interesting. Tell me a little bit more. And you start mapping out, you start looking at the remuneration arrangements. You look at the way they set up. They have an administrator. One has an administrator in Ireland. One has in, prime broker in New York. Whoa, you're not the same. So what looked like the similarity is actually, so your own fact pattern, your impact assessment needs to be undertaken. And if you're out, that's great. I'm really pleased for you, but then has it been properly documented? So you don't have that wake up call when the tax authorities come knocking on your door. The other challenge that I think sort of like is then once you've done the impact assessment, there is this whole back book exercise. You've got to go back to 2018, look at all arrangements, package all your data. It's very data hungry, and then determine whether a report needs to be filed or not. And then on a going forward basis, what we were talking about just now are the first of all, a policy level, and also the procedures that need to be implemented to ensure that you're able to detect, capture, and report going forward. Now, in order to do that, it's not just about a document that you get some consultant to come in and write for you. It is about building capacity within your own staff. That requires both the skills and the training for them to be able to discharge that responsibility. So that's essentially what a manager needs to be looking at very actively straight away. I can also tell you the other part which needs a lot of attention is, and I think there was a question about this, is the whole intermediary. So the asymmetry between intermediaries needs to be solved very, very quickly. A lead, this is my solution that when I'm working with clients, I always put forward is, are you ready to take on that lead role? Take the intermediary. Don't let the bank. I mean, I don't want, some custodian bank, because banks tend to be quite trigger happy. They don't always understand funds. And they're just going to look at it and say, whoa, they're operating in Guernsey and they've got this. I'm going to report because they have a legal responsibility. Put them out of their pain. Go and talk to your administrator, to your bank and say, guys, don't worry. I'm the prime intermediary. You don't need to worry about it. And I'm sure Sutha will sleep better at night if somebody, his funds came and they said, look, Sutha, you don't need to worry. We will take care of it. And I think that's a very important dialogue between the intermediaries.
And in terms of, I mean, you focus on documenting. So even if you know off the top of your head, you think you're going to be outside the regime, you do the review process and you still conclude you're outside the regime. The process of documenting it is important because it provides evidence to HMRC in case they come knocking on your door. And if HMRC do knock on your door and you don't have a documented review, what are the consequences if they felt that something should have been reportable?
Okay, look, there is a pretty draconian sort of like penalty regime that goes with this. Okay, and I've been on the other side of the fence, and I would have these consultants come in and they would start telling me about fines and things, and I would sort of say, yeah. You don't want to hear about those things, but I'm gonna, because it is what it is. I'm gonna have to tell you what it is. Simply put, the UK has regulation where it's clearly spelled out that at the highest level, you could be fined up to 1 million if you get it wrong. £1 million sterling. The other big jurisdiction, someone like, say, for example, Luxembourg, has a €250,000. And you've got 4 funds or whatever, and you decide to, I've just made a back of the fact packet, determination that I'm not going to report or there's nothing to do. Well, I think there is definitely a lot of risks, sitting there, and I'm not sure whether it's your hedge fund or private equity fund or real estate fund, that if you speak to the fund board or the asset management sort of like board, that you say, do you have appetite to write that kind of risk? So I think sort of like heads of taxes and tax departments have a real duty to go back, engage with their seniors, the key stakeholders, say, look, guys, we need to do this properly. This laissez-faire approach. Yeah, we're not really caught by this, which is what you started off by saying, Sutha. I think that's really quite dangerous and quite reckless to go down that path. It's not a plug, but one of the things that we do is, as a firm, is we come in, we look at it, and we try to operationalize it, but importantly, document these key things. In a condensed 45-day period, you've got to get across the line very, very quickly. And if you've got, say, for example, the German nexus then there as well, you're looking at an even more accelerated timeline. So I don't think there's much room for dilly-dallying at this stage.
I guess, we've only got another 5 minutes left. From my perspective, all of this, you and I have just had a little bit of a debate about what could or could not be a circular transaction. All of this just shows how complicated DAC6 is. But if you think about the tax regime in general, tax is just getting harder and harder and harder. And in terms of things like DAC6, and if you even go back to things like making tax digital with VAT, we seem to be providing HMRC with so much information. Where are we going with all of this? Are we getting to the stage where you may as well just tell HMRC everything you're doing?
Yeah, I mean, obviously I keep a really keen eye on this kind of stuff. And, HMRC's Connect system is very, very powerful. Regularly talk to Simon York, who, as you know, sort of like, is the guy in charge these days. We've got both, John Buckridge, who wrote the RFS guidance, and Chris Orchard with us in my firm. And, we have a view on that market, and we think, it is going to go down the data hungry route. That's what it is. But I think it's shifted the ground considerably. We as tax advisors have two essential responsibilities. First of all, to be able to protect firms, okay? And you protect firms through two things. First of all, the governance needs to be very, very strong, okay? Very robust. You should have done internal sort of like, reviews where you've actually sort of like test driven it. So if HMRC comes knocking, or, whichever tax authority comes knocking on your door, you actually are demonstrating a really robust process, because they've gone down the path. I mean, the days when I used to sit there, sort of like in my early days in my career, where we used to have intellectual, technical arguments with HMRC, they're long gone. That doesn't happen anymore. They sniff, they risk assess you, and then they decide to maneuver. Now you have to play that game. You have to have systems and controls in your organization. So a lot of our implementation in DAC6 is actually not about the hallmarks. Of course, we go through them, but it's actually putting in place a really robust system in a very quick time, which can withstand a invasive HMRC inquiry. And that's where the likes of sort of like, John Buckridge and Chris Orchard will work alongside us, so that they, you send a signal to HMRC and say, Simon, listen, there's no point. Chris and I have worked on this before. You're pretty, you're barking up the wrong tree.
So Ali, again, focusing on time right now, 3 minutes left. So just very quickly then, what are the takeaway points for everyone?
So I think sort of like number one is time. As I said to you, there's this deferral, potentially that is being granted, not so you can press the snooze button and go back to sleep for the next 6 months. It's there for a reason. It's an opportunity to get your house in order. As I said to you, the real pain points are around the multi-intermediary and the back book, okay? And these things need to be built, put around in a sort of like in a project discipline, and week by week you need to move forward. Now my concern is sort of like, it's the 31st of July today. Most of the market is about to sort of like go into holiday mode, particularly continental Europe. And, exactly, on 31st of August, there's a German report to be filed. So if you have an excess and you've got a big institutional, big hairy investor from Frankfurt, you better get your skates on, because the thing is, I can tell you, I'm dealing with that big hairy monsters from, Frankfurt. They're asking questions. They're sending big lists saying, where are you? Can you please tell us? So I think sort of like those managers who rely on institutional money, particularly German institutional money, need to be ready for this.
Okay, so I guess basically document your review, don't ignore it, and make sure you've got the system in place to identify future transactions, even if you think at this stage you don't think it's relevant.
Yeah, I mean, at a minimum, give me a shout, come and talk to me.
Yeah. Okay, Ali. I know that I can see some questions on the chat section, and I assume you can see that as well. We're not going to have time.
No, I can deal with it very quickly. 10 seconds. Multi-intermediary, start talking. Okay. Are you expecting ad hoc reviews? Absolutely. HMRC already announced that. David Smith was with us and he's basically already got a program going on the audits. The bridge finance, potentially in scope, but again, you have to need to look at whether the MBT shield is available or not. And secondly, what is the role that you're playing as an intermediary or not? How was that?
Very good, very good. I think we shall close it now. Thank you everyone for listening in, and please do get in touch if you have any more questions. Thank you.